Have you ever wondered how your financial advisor actually makes money? If they told you that their advice is completely free or that they only get paid by the fund houses, I want you to stop and take a deep breath. In the world of wealth management, free is often the most expensive word you will ever hear. The harsh truth is that nobody works for free, especially not when it comes to managing millions of rupees or dollars. If you are not paying a clear, transparent fee upfront, you are likely paying a much higher price behind your back. Over a lifetime of investing, these hidden costs can quietly slip away with 30, 40, or even 50% of your total potential wealth. Welcome. I am Kunal, and at EPK Capital, our philosophy is simple. We build wealth for generations. Over my past 20 years in investment and wealth management, working across both Indian local markets and global investment strategies, I have seen the good, the bad, and the outright ugly sides of this industry. Today, I want to pull back the curtain. I want to share 7 critical red flags that could mean your financial advisor is quietly ripping you off, sacrificing your long term financial freedom for their short term profit. Make sure to stay till the end for a special surprise that I have for you. And if you happen to like the content of the video, please do like and share the video. Also, do subscribe to our channel for learning everything from the world of investments and finance to make your future a secured one. Let's start with the biggest illusion of all, the myth of free advice, which usually shows up as the difference between regular and direct plans in mutual funds. Many traditional advisors and bank relationship managers will tell you that you do not have to pay them anything because the mutual fund company handles their compensation. What they are not telling you is that they are putting your money into regular plans. These plans carry a hidden trail commission, often ranging from 1% to 1.5% every single year. It might sound like a tiny number, but let's look at the math over the long run. If you invest a crore of rupees, 1.5% means 1,50,000 rupees is leaving your portfolio every single year, regardless of whether the market goes up or down. Compounded over 20 or 30 years, this single hidden commission can easily wipe out crores of rupees from your retirement nest egg. A transparent advisor will always tell you exactly what they are earning, or better yet, recommend direct plans and charge you a flat, transparent fee for their actual expertise. The second red flag to watch out for is a dangerous practice called portfolio churning, which simply means frequent, unnecessary trading. Have you noticed your advisor constantly calling you with new ideas, telling you to sell a fund you bought just 6 months ago to buy a hot new thematic fund? Or perhaps switching your investments from one structural asset to another every few quarters? Ask yourself, who really benefits from this constant movement? Every single time an asset is bought or sold, it triggers transaction fees, potential entry or exit loads, and massive brokerage commissions that go straight into the advisor's pocket. But for you, the investor, it does something far worse. It destroys your tax efficiency. In India, short term capital gains are taxed much higher than long term capital gains. And globally, frequent trading is the easiest way to hand over your profits to the tax authorities. True wealth management is about patience and long term asset allocation, not chasing the flavor of the month just to generate commissions for an intermediary. Next is the classic in house product push. And this is incredibly common if you manage your wealth through large banking institutions. You meet with your dedicated relationship manager, and without fail, every solution they propose happens to be a product manufactured by their own parent bank or insurance company. It could be a proprietary insurance cum investment plan, a structured note, or an in house portfolio management service. This is a blatant conflict of interest. The global investment universe is massive, with thousands of outstanding, independent funds and strategies. The odds that your specific bank's in house product is the absolute best fit for your unique generational wealth goals are incredibly low. When an advisor stops scanning the entire global market and starts acting like a salesperson for a single brand, they are no longer looking out for your financial health. They are simply fulfilling their monthly internal corporate sales targets. The fourth warning sign is any guarantee of outsized or risk-free returns. We all want high returns, and it is easy to be swayed by an advisor who confidently promises you a steady 15 or 20% return with absolutely no downside risk. But let's be completely grounded here. Risk and return are two sides of the exact same coin. They cannot be separated. Anyone promising you market beating returns without any risk is either lying to you or they are exposing your capital to complex, toxic financial instruments that you do not understand and that could blow up during a market crisis. Real institutional grade wealth management is never about timing the market perfectly or chasing speculative, guaranteed tips. It is about rigorous risk management, protecting your downside, and creating a resilient asset allocation strategy that can survive economic storms. If an advisor sells you a dream of pure profit without a realistic discussion about risk, walk away. Red flag number 5 is the one size fits all portfolio. Take a look at the investment plan your advisor has given you and then think about your neighbor or your colleague at work. If your advisor is recommending the exact same set of 4 or 5 mutual funds or stocks to everyone they meet, you are stuck in a product pushing assembly line. A genuine financial plan requires a deep, comprehensive dive into your life. It requires understanding your family's unique timelines, your cash flow requirements, your emotional tolerance for volatility, your cross border taxation liabilities, and your legacy goals. If an advisor skips this meticulous discovery process and hands you a pre packaged, cookie cutter portfolio within 30 minutes of meeting you, they are not practicing wealth management. They are just selling financial groceries off a shelf. Then we have the painful reality of ghosting and selective communication. We have all experienced this at some point. When you have a large sum of money sitting in your bank account, or when there is a lucrative new product to buy, your advisor is your best friend. They call you twice a day, they send elegant presentations, and they are highly attentive. But what happens when the global markets crash, or when the Indian indices take a sharp correction? Suddenly their phone goes silent. Your emails go unanswered for days. This selective communication is a massive red flag. A true wealth partner proves their value not during the bull markets when everything is rising, but during the painful market downturns. You need an advisor who proactively reaches out during a crisis to rebalance your portfolio, steady your nerves, and execute a clear, rational strategy when everyone else is panicking. If they only show up when it is time for you to sign a check, they are an order taker, not a wealth custodian. Finally, red flag number 7 is a complex, opaque fee structure. If you ask your financial advisor a direct question, like exactly how many total rupees or dollars did I pay you over the last 12 months across all my investments, you deserve a straight, simple, and immediate answer. If instead, you receive a convoluted explanation about institutional rebates, embedded costs, platform fees, and layered expense ratios that leaves your head spinning, something is wrong. Elite fiduciary wealth managers operate with absolute radical transparency. They disclose their fees upfront in black and white because they are proud of the value they deliver and have nothing to hide. If your advisor goes out of their way to obscure the math, it is usually because they know that if you saw the actual total cost, you would be shocked. Now that you know these 7 red flags, I want to give you a concrete, immediate action item. Download your latest consolidated account statement. Sit down with your current advisor, look them in the eye, and ask them the hard questions we discussed today. Ask them if they are putting you in regular or direct plans. Ask them to give you a single dollar or rupee figure for the total compensation they made from your assets last year. Observe their body language and listen closely to their answers. Now, as a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. At EPK Capital, we firmly believe that building wealth for generations requires a foundation of absolute truth and transparency. If your gut feeling tells you that your current financial setup is compromised, or if you simply want a clean, unbiased perspective, we are here to help. Reach out to us for a comprehensive, no obligation portfolio health check. We will analyze your current holdings, expose any hidden costs or conflicts of interest, and give you a clear map forward. Your hard earned wealth deserves to be protected, nurtured, and passed down seamlessly. Let's make sure it stays exactly where it belongs, with you and your family. Thank you for listening, and let us build a secure, transparent financial future together.